Taylor rule is a central bank reaction function that links policy rate to inflation gap and output gap. In this special report, we estimated augmented Taylor rules for Asian monetary policy to explore the various themes. The first, we look at the major changes that have taken place in Asia's central bank reaction functions since the 2008 global financial crisis. We then address what are the best representative reaction functions today. Finally, we provide normalized forecasts for Asian monetary policy next year. Since the 2008 crisis, Asian central banks have demonstrated a strong commitment to inflation targeting and domestic price stability. We found that South Korea has conducted counter-cyclical policies. This is because well-anchored inflation expectations has helped to limit the pass-through of exchange rate to domestic prices and allowed monetary policy to focus more on reducing output gap. In contrast, Indonesia and Philippines have conducted a pro-cyclical policy, the meaning that those central banks hiked interest rate to manage inflation risk at the cost of the weaker growth. This is mainly because the capital flows complicated monetary policy in these economies. For example, monetary policy is tightened when capital outflows and a currency depreciation result in weaker growth and a higher inflation. We also judged that Korea and India conduct a more rule-based monetary policy because they maintain inflation targeting framework. In contrast, China and Malaysia's monetary policy is more discretionary because they do not have any specific intermediate target. We believe inflation and monetary policy normalization will be the two main drivers for further but final rate hiking cycle into 2019. The only exception is China, where we expect outright monetary policy easing.